Gold isn't randomly rallying right now. Capital flows are re-entering the trade, and the dollar's losing grip is making it harder to cap the move. And the weird part is, the loudest people are still arguing about headlines while the real signal is hiding in the plumbing. Because when ETF flows flip from outflows to inflows, that's not a vibe shift. That's a sourcing problem. That's a hedging problem. That's a market structure problem. And by the end of this, you're going to have a clean checklist for the next week or two. The levels that matter, what would confirm the move, what would weaken it, and the one tell that basically decides whether this is a controlled retest or a continuation squeeze that punishes anyone waiting for the perfect entry. Now zoom in on what just happened. Earlier this month, gold was down in the low $4,300, then it ripped through the 4,400s, stepped over the 4,500s, and in the last stretch, it's been printing in the 4,600s with fresh record highs near the upper end of that zone. That's not the behavior of a market that's finished. That's the behavior of a market that's being repriced in real time, while participants argue about why it's even allowed to go up. And that's where the real pressure starts. Because if this were just emotional panic buying, you'd see it spike and fade. You'd see the rally lose its spine the moment the scary headline cools. But this move has structure. It has persistence. It has that slightly uncomfortable feel where dips don't last long enough for people to get comfortable. And that's exactly what happens when demand isn't just discretionary. It's systemic. It's flow-driven. We have to rebalance demand. The conflict right now is simple. A big chunk of the market is trained to think gold only moves when the world is on fire, or when central banks are printing, or when something breaks on a screen. So when gold pushes to new highs while the dollar cools and yields aren't doing some cartoon collapse, they start hunting for a narrative that makes them feel safe. But the mechanism is cleaner than the narrative. And the dollar cooling matters because gold is priced globally in dollars. The moment the dollar stops tightening the screws, stops making everything else expensive, gold doesn't need a dramatic catalyst. It just needs the opportunity cost to stop rising. And in markets, not getting worse is often the first stage of getting better. But that's still not the hidden detail. The hidden detail is that the price you see on the screen is only one layer of the gold market. The spreads are the nervous system. The curve is the mood. The positioning is the muscle. And the ETF flow is the heartbeat. You can ignore one of those and still survive. Ignore all of them, and you're trading a story while the market trades math. Here's the part most people miss about ETF inflows return. When money flows into a physically backed gold ETF, new shares don't magically appear out of thin air. There's a creation and redemption process. Think of it like a warehouse receipt system with a gatekeeper. Big institutions called authorized participants can create shares by delivering the underlying, delivering gold bars that meet specific standards into the trust, and in return they receive ETF shares they can sell into the market to meet investor demand. When there are outflows, it goes the other way. Shares get redeemed and metal can come out. This matters because ETFs are not just a sentiment scoreboard. They are a mechanism that can transmit capital into real-world metal sourcing and hedging behavior. And that's not the part that matters. The part that matters is what it forces other players to do. Because the authorized participant doesn't just wake up and say, sure, I'll go find a pile of gold because retail investors are enthusiastic today. Well, they manage risk. They source metal through the wholesale market. They hedge exposure in futures. They deal with financing. They deal with the curve. They deal with physical constraints. So when ETF demand returns, you don't just get a clean buy spot impulse. You get a chain reaction, sourcing pressures, hedging flows, and sometimes a scramble for the cheapest to deliver inventory that changes how price discovery behaves. And if you're only watching the headline, gold ETF inflows, you'll miss the second order effect that moves price harder than the headline itself. Because if this one level breaks, the math changes. Now let's talk about the dollar cooling, because this is where people get sloppy. The dollar doesn't need to crash for gold to go vertical. Gold is sensitive to the direction and momentum of real rates, inflation expectations, and dollar liquidity. When the dollar index cools off, when it drifts lower, especially after a period of strength, it loosens global financial conditions. It reduces the headwind for commodities and for anything priced in dollars. It also changes the reflexive loop. Foreign buyers see a less punishing exchange rate barrier, and dollar-based investors start recalibrating the carry trade logic, where holding cash or short duration yields felt unbeatable. In other words, the dollar cooling doesn't have to be dramatic to matter. It just has to change the marginal decision. And in markets, the marginal decision is everything. But that still doesn't explain why the flow flip matters right now specifically. The calendar does. This is a scheduling problem disguised as a macro story. We're in a window where funds care about month-end reporting, risk books get adjusted, and volatility itself becomes a constraint. Add in a policy calendar where trade threats can hit sentiment and risk premiums quickly, and you get thin liquidity at exactly the wrong times. When liquidity thins, price doesn't move like a smooth curve. It jumps, it gaps, it overshoots. That's just why you all see gold look calm for a few sessions, and then rip $100 in what feels like a blink. The market isn't being dramatic, it's being illiquid. And that's the next detail that flips the whole setup. Because the people who try to wait for confirmation often end up buying higher, not because they're dumb, but because confirmation in a thin market arrives as a gap. Then they panic when the gap fills. Then they sell the retest. Then the move continues without them. That cycle is not a skill issue, it's a structure issue. So if you want to understand this move, stop asking, is gold bullish? And start asking, who is forced to transact? At what time? Under what constraints? That's the real question. And it leads straight back to ETFs and the dollar. Late last year, gold ETFs saw a sustained period of inflows that built a base of support. And 2025 overall was widely described as a record year for gold ETF inflows in dollar terms. That tells you something simple. Institutional and semi-institutional money did not abandon gold. It rotated, re-entered, and scaled. And now you could have seen the early stages of that returning in a way that matters for price discovery. Because when inflows return after a lull, it often coincides with a narrative shift. Maybe the dollar isn't the one-way bet anymore. And that narrative shift changes positioning. Not everyone has to buy gold for gold to move. Only the people who are short and under-margined have to buy. Only the funds who benchmark against a portfolio allocation model have to buy. Only the dealers who sold optionality and need to hedge have to buy. And that's where the real pressure starts. Let's layer in a proof stack, but in a way that actually helps you trade your emotions, not just your chart. Proof point 1 is the chart structure itself. Gold didn't just spike to a new high and fall apart. It advanced in steps. It showed that buyers were willing to pay up after shallow pullbacks. That's a classic signature of a market transitioning from debate into acceptance. In a debate phase, every rally gets faded hard. In an acceptance phase, dips get absorbed and sellers struggle to push it down far enough to trigger real liquidation. That's what higher highs with stubborn support looks like. Proof point 2 is the dollar impulse. When the dollar weakens even modestly after a period of strength, it changes the cross-asset map. It doesn't automatically mean gold must rise, but it removes a key headwind. And when a headwind disappears at the same time flows are turning, you get something very specific. Rallies that persist even when the news flow is messy because the marginal buyer isn't trading the news. They're reallocating. Proof point 3 is positioning. Publicly available positioning gauges for gold futures show that speculative participation can rise without necessarily being at extreme levels, which means you can get higher prices without requiring everyone to already be all in. That matters, because the most dangerous tops happen when positioning is crowded, leverage is high, and the only thing left is latecomers. When there's still room for marginal inflows, rallies can last longer than skeptics expect. Proof point 4 is the real-world symptom layer. Retail and physical market chatter tends to heat up when prices hit records, and you start seeing premiums, availability talk, and backorder language. That doesn't prove a bull market by itself. Retail is often late, but it confirms something else. Attention is shifting, and attention is a form of demand, especially when it brings ETF flows with it. Proof point 5 is market structure behavior. The way price moves around key levels tells you whether liquidity is thin and whether there's forced buying. If gold breaks into the upper 4,600s and then refuses to give back the level on a pullback, that's not just support. That's forced demand absorbing supply. That's the difference between a breakout that's real and a breakout that's a trap. But that's not the part that matters. The part that matters is the hidden mechanism. Spreads and the curve often lead spot. Here's the clean version. Gold trades across spot, forwards, futures, and options. Futures are not just a bet. They're a hedging instrument for miners, refiners, jewelers, and big dealers. The forward market reflects financing and availability. When physical demand tightens relative to immediate supply, you can see stress show up in the relationship between nearby and deferred prices and in the cost of borrowing gold versus dollars. You don't need to become a derivatives wizard to use this. You just need to understand one concept. If the market is paying a premium for immediacy, if near-term demand is stronger than the willingness to hold future supply, then price tends to become more sensitive to shocks because there's less cushion. And when there's less cushion, small changes in flows create large changes in price. That is the paper versus physical tension people talk about without explaining it. The tension isn't a conspiracy, it's incentives. Paper claims can trade at scale quickly. Physical settlement has constraints, logistics, assay standards, delivery windows, and financing. When ETFs pull in metal or force hedging behavior, they can tighten that system at the margin. And margin is where markets break. Because if you're short futures and the market moves against you, you don't get to debate it on a podcast. You post margin. If you can't, you reduce risk. That means you buy to cover. That's why flow-driven markets can feel unfair. The timeline is set by risk managers, not by your confidence. And that's where the real pressure starts. And now let's talk about why ETF inflows return as the dollar cools is not just a descriptive headline, but a setup. In markets, the most powerful moves are the ones where two forces align, a macro tailwind and a mechanical tailwind. The macro tailwind is the dollar cooling and the broader uncertainty premium that pushes investors towards stores of value. The mechanical tailwind is the flow into a structure that forces sourcing and hedging behavior. When those align, you get a kind of price action that makes people feel like they're late, even when they're not, because price moves faster than comfort, and comfort is a trap. But that's not the part that matters. The part that matters is what happens next week and the week after, because that's where a lot of people get emotionally farmed. Here are the two scenarios you need to hold in your head at the same time, because both can be bullish and one will feel bearish while it's happening. Scenario one is the controlled pullback and retest. Gold holds the broader uptrend, but it pulls back from record highs because profit-taking and hedging kick in. It drifts down into a prior breakout zone. Think the low to mid 4,600s, possibly even flirting with the high 4,500s. And then it stabilizes. Volume calms. The tape stops feeling frantic. Then you see a higher low and a push back toward the highs. This is the scenario that shakes out impatient buyers and triggers "I knew it" posts from skeptics right before the trend resumes. It's also the scenario where you'll hear the most emotional manipulation, because drawdowns create narrative space. You'll get gold is topped talk. You'll get ETF flows were a one-off talk. You'll get dollar is back talk. And the trick is, some of that will sound plausible. That's how it works. But the confirmation for this scenario is simple. Pullbacks get bought and the dollar doesn't surge. If dips are absorbed quickly and the market refuses to spend time below key support, the trend signal stays intact. Scenario 2 is the continuation squeeze. Gold doesn't give you the polite pullback. It consolidates shallowly, then rips again, possibly through the upper 4,600s into the next psychological zone, because flows stay hot and liquidity stays thin. This is where gap risk appears. This is where shorts and underhedged participants scramble. This is where headlines chase price rather than lead it. And this is also where people get punished for waiting, because the move happens in a burst, not in a staircase. The confirmation for this scenario is also simple. Breakouts hold, and pullbacks are microscopic. You'll see sharp intraday dips that instantly reverse. You'll see the market trade like it's being chased. That's the dealer hedging and forced covering signature. And that's not the part that matters. The part that matters is how you protect your brain in either scenario. Because even if the thesis is correct, price can whip around violently. That's not a bug. That's the market doing its job, transferring money from emotional hands to prepared hands. Your job isn't to predict every tick. Your job is to separate trend from noise. Trend is the persistence of higher highs and higher lows, supported by flows and a friendlier macro impulse. Noise is the intraday drama. The headline spikes, the social media certainty, the "this changes everything," takes that show up right before the move reverses. If you confuse noise for signal, you'll either chase tops or sell bottoms. That's how volatility farms you. So build a psychology shield right now. Step 1, expect whipsaws. Expect it. If you expect clean price action in a flow-driven market, you're volunteering to be surprised. Step 2, decide what would actually invalidate the thesis. Not what would make you uncomfortable, not what would make your friends tease you, what would actually break the mechanism. For this setup, invalidation looks like a meaningful dollar resurgence that tightens conditions again, combined with ETF flows stalling or flipping back to persistent outflows, combined with gold losing key support and failing to reclaim it on a retest. That's a real break. A scary red candle isn't. Step 3, accept that the market will attempt to manipulate your emotions through timing. It will dump right after you buy. It will rally right after you sell. Not because it knows you, but because your timing is clustered with other humans reacting to the same cues. That clustering is what market makers and risk managers understand. They don't need to target you. They just need to let you do what you always do. And that's where the real pressure starts. Now let's get concrete, because vague optimism is useless. Here are the levels and tells that matter in the next week or two. In the near term, the zone around the mid $4,600 is a battleground, because it's where recent strength has been defended. Above that, the upper 4,600s is the acceptance zone, where breakouts can turn into acceleration if price holds there. Below that, the high 4,500s becomes the danger area, where a deeper retest can happen without breaking the bigger trend, but where weak hands often panic. You don't need perfect numbers. You need zones. Markets trade zones because participants hedge zones. Watch how gold behaves when it touches those zones. Does it snap back quickly, or does it linger and bleed? Lingering is not automatically bearish, but it changes the rhythm. Quick snaps back are a sign of aggressive absorption. Now for the tells. Tell number 1 is the dollar's follow through. If the dollar keeps cooling or at least fails to rally hard, gold gets room. If the dollar suddenly rips higher, gold will feel it fast. Tell number 2 is whether ETF flow commentary stays positive. You won't get real-time perfect data in every moment, but you can feel it in the market's resilience. When flows are supportive, dips feel like they have a floor. When flows fade, dips turn into slides. Tell number 3 is cross-market behavior. When gold is leading and silver is lagging hard, the market is often in a cautious, institution-heavy posture. When silver starts catching up aggressively, it can signal a more speculative phase. That can be bullish, but it's also where volatility spikes. Tell number 4 is term structure behavior and the feel of the front end. You don't need to quote spreads. You need to sense whether immediacy is being bid. When immediacy is being bid, breakouts hold more easily. Tell number 5 is volatility itself. If volatility rises while price holds, it often means the market is being repriced, not rejected. If volatility rises and price collapses through support, that's liquidation. Those are different. Treat them differently. But that's not the part that matters. The part that matters is the why now trigger. This is happening now because the calendar is compressing decisions. Funds adjust exposures around month end. Risk managers tighten limits when volatility rises. Policy talk can introduce sudden uncertainty premiums, especially around trade and geopolitical headlines. In thin liquidity, these catalysts don't need to be huge to move price. They just need to be timed. That's why you'll see gold lurch on what looks like just talk. The market isn't pricing only the talk. It's pricing the distribution of outcomes and the cost of being wrong when liquidity is thin. That's the quiet institutional behavior that just turned loud. They don't need to be enthusiastic. They need to be protected. And protection often looks like gold. Now let's deal with the counterpoints, because trust requires it. Counterpoint 1, gold is already at record highs, so it's too late. That's a psychological statement, not a market statement. Markets don't care about your feelings of lateness. They care about positioning, flows, and marginal incentives. Record highs can be the beginning of a repricing, not the end, especially when the move is supported by allocation shifts rather than pure speculative mania. Counterpoint 2, if rates stay high, gold shouldn't do this. That's an oversimplification. Gold responds to real yields and the broader liquidity impulse, not just nominal rates. And even when yields are stable, a cooling dollar and rising uncertainty premium can support gold. Counterpoint 3, ETF flows can reverse quickly. True. That's why you don't marry the trade. You track the mechanism. If flows flip back to outflows and the dollar firms, the setup changes. Not in theory, in practice. Counterpoint 4, the move could be headline driven and fade. Also true, which is why the 2-scenario lens matters. If you get a controlled retest, that might be the market proving the move is real by building a base. If you get a continuation squeeze, that might be the market front-running itself. Either way, you manage risk by respecting levels and not mistaking noise for a thesis break. And that's where the real pressure starts, because the market's job is to make you react at the wrong time. Here's how it does it. It makes you feel smart when you're cautious at the bottom. It makes you feel safe when you're cautious at the top. Then it flips the script. It makes you feel stupid for buying and brilliant for selling, right before the trend resumes. The antidote is simple. Stop letting emotions interpret price. Let mechanics interpret price. If the dollar is cooling, flows are returning, and breakouts are being defended, the trend signal is alive, even if the path is violent. If the dollar strengthens, flows stall, and support breaks and fails on retest, the thesis is weakening, even if the narrative is still bullish. That's the difference between trading a story and trading a system. Now, let's talk about what institutional players are likely doing right now, because this is where retail gets blindsided. Many institutions don't believe in gold. They allocate to gold when their risk models tell them to. When volatility rises, correlations change, and policy uncertainty increases, gold becomes a hedge, a diversifier, or a tactical allocation. That means demand can show up even in a room full of skeptics. That's why you can see inflows return without a grand consensus forming. And if the dollar is cooling at the same time, it makes the hedge cheaper in relative terms. It makes the carry math less punitive, so the flow can persist longer than you'd think. And that's not the part that matters. The part that matters is what happens when enough of those allocations stack. Because then the market doesn't need new headlines to move. It needs inventory. It needs liquidity. It needs sellers. And in a thin environment, sellers don't show up at the price you want. They show up at a price that hurts. That's how squeeze dynamics form without anyone shouting, squeeze. See, it's just margin and scarcity doing what they do. Now, I'm not here to sell you a fantasy where gold goes up every day forever. That's not finance credible. Gold can dump hard, even in a bull regime. It can flush a couple $100s in a week and still be bullish on the month. That's why your time horizon matters. A trend can be up while your position is down. That's not a contradiction. That's reality. So your edge is not predicting. Your edge is staying rational while others get emotional. Here's your near-term roadmap. Over the next 5 to 10 trading days, watch 3 things like your life depends on it. 1, does the dollar keep cooling or at least fail to rally hard? 2, do pullbacks in gold get absorbed quickly, especially around the mid-4600s and into the high 4500s if it dips there? 3, does the market reclaim highs after pullbacks with less effort each time, or does it need bigger and bigger pushes? Effort matters. A market that needs less effort to climb is being supported by flows. A market that needs more effort is tiring. Then add your invalidation lens. If gold loses a key support zone, fails to reclaim it on a retest, and the dollar strengthens into that weakness, you don't argue. You adapt. That's risk management, not stubbornness. And if you get the continuation squeeze scenario, shallow pullbacks, quick snaps, breakouts that hold, respect the gap risk. Don't let FOMO turn you into exit liquidity. Gap risk is real. It's how thin markets punish certainty. Finally, here's the subtle CTA, and it's not begging. If you're still here, you're not the headline crowd. You're the mechanics crowd. Keep it that way. Don't outsource your conviction to a hot take. Build your own checklist, track your levels, and stay anchored to what actually moves price. Flows, the dollar impulse, and the structure beneath the screen. Because the people who win in markets aren't the ones with the loudest predictions. They're the ones with the cleanest process when volatility tries to bully them.